to welcome you all here today. And today is the Lunar New Year celebration for China SF in particular, as well as SF Asia, right? And if you don't know what they are, let me tell you a little bit. Just quite simply, China SF was started in 2008 by then Mayor Gavin Newsom, who, as you all know, is the governor of California. And for him, it was all about, let's start a China desk to attract Chinese foreign direct investment and help Chinese companies land in San Francisco. So we started in 2008. And then SF Asia was started because our late Mayor Ann Lee became mayor in 2011. And then after the good work that China SF was doing, after I came on board in 2012. Anyway, after all the good work that we were doing in terms of attracting foreign direct investment, he says, we've got to do this in Asia, outside of China, and we have to do this and we have to do it with the other countries, as well as actually with Latin America. So we started SF Asia and Latin SF in 2015.
It was actually online, so I'm very happy to be here in person tonight to be able to talk to everyone. And we're very, very excited to be able to sponsor this event, and with the social impact investing and the Global Greater Bay Area Initiative topic today. So we are also, today Woodland is also representing the city of Guangzhou to sponsor this event as well. City of Guangzhou is one of where our science parks is located. And so a little bit about Woodland. Woodland is a family office that's backed by a global multi-billion-dollar real estate conglomerate from China. And we're actually a very active tech investor. We invest into different asset classes, including venture, growth, late stage, and public equities as well. But I would say we're very stage agnostic, but what we focus on is tech investing. So we're very excited to hear about what panelists have to say today about social impact investing, because that's what Woodland focuses on as well. Even in the investments that we do and everything we do, we want to be very social responsible and give back to the society and be environmentally friendly. So yeah, very excited to hear what everyone has to say today. And actually, one of our portfolio companies is here tonight as well. He's the CEO and founder of Patch Medical, Robert. He is from one of our portfolio companies and is a digital health company. And he was very interested to come tonight to hear what the panelists has to say actually about social impact investing, because that's what he focuses on. He focuses on using technology and AI to make things cheaper, better, faster in the health world, and to make things cheaper, better, and faster for the patients. So Robert's over there, and Robert, if you have any questions for the panelists, make sure you ask during the Q&A. So yeah, that's really, from me, really great to see everybody, even though it's 1 month late, but better late than never. Happy New Year! And on behalf of City of Guangzhou, Happy New Year! And 我在此也代表广州市祝大家新年快乐，虎年行大运。谢谢。
Thank you so much, Judy. It's clearly about investment and collaboration between U.S. and China. And even with the disruptions that were caused by the pandemic, and now the conflict with Ukraine, there are serious considerations in terms of how do we address the supply chain as well as inflation, especially here in America. And these issues have particularly affected California. We are the 5th largest economy in the world, and the thing is, it has definitely affected incomes of color and low-income communities. These domestic and offshore issues have raised awareness of the need for a more regenerative and circular economy, and an economy at once more resilient and more equitable when we talk about the different communities. Nowhere is this more apparent than from an investment perspective, whether domestic or FDI, so much so that social impact has definitely become a buzzword today. So with that, I would like to invite our panelists to talk about impact investing and why specifically China outbound investment. First of all, we have Andy Rothman, investment strategist at Matthews International Capital Management. Andy was a career foreign service diplomat before leaving for the private sector to become a China macro strategist in Hong Kong, and then came back home to the USA. He now resides here in the Bay Area and joined Matthews Asia, where he's now responsible for research on China's economic and political developments while working on strategy complementing the work in the rest of Asia. Andy, would you take a seat, please? Next Next, we have Lu Zhang, Director of International Tax at Moss Adams. She specializes in cross-border taxation, M&A, transfer pricing, and very well positioned to take part in our conversation today. Lu Zhang, please. Next, we have Jonathan Wetzel, one of my favorite people, really. I don't want to do that, but he's making He is the senior partner at McKinsey and director of McKinsey's Global Institute. He is based in Shanghai and has obviously spent a lot of time stateside of late due to the pandemic. So with that, thank you for joining us. He has to leave early. He's celebrating his wife's birthday today. So. See, isn't he sweet? Last but not least, we have Rajesh Nakati, Head of Investments, Global Family Office at BNY Mellon. I should note that he is an aeronautical engineer. No kidding, seriously. And I should note that he went back to get a business degree at Wharton and has been working for investment banks starting with Merrill Lynch. He is currently based in New York, so thank you so much for joining us today. Please. Into what is going on in China and help us understand why there continues to be outflow of dollars.
Okay, thanks, Darlene. Great to be here with you all. Happy New Year. 新年快乐. 恭喜发财. And where is the representative from Guangzhou? 恭喜发财. I'm really glad to see her because I got my start in China actually living and working in Guangzhou in the early 1980s as a very junior American diplomat. So great to see anything from Guangzhou. So I'm going to just give a brief outline of where I expect the Chinese economy to go this year because I think that will provide some background for the other speakers who are more familiar with the issues related to Chinese investment into the United States because my focus is more on foreign investment into China and the Chinese economy. And I think it's going to be a pretty good year for the Chinese economy this year. And that's important for us because if it's a strong year in China, it gives Chinese investors more confidence to go overseas and more money to go overseas as well if their businesses in China are doing well. And last year was a tough year. Not only was there COVID, but also government policy towards the economy was quite tight. They made it hard to get bank loans, they made it hard to buy houses. In many cases, they made it hard to run businesses. But things are changing this year, so we've already seen a loosening of monetary policy. It's going to be already starting to be much easier to get a bank loan if you're a small business in China. We're also seeing the beginning of what I think is going to be a pretty significant fiscal stimulus. So the government announced last weekend that their spending is going to go up 16% compared to last year. That's quite a large increase, including a 7% increase in infrastructure construction. And infrastructure construction is something that China does well and does quickly, unlike some other places we know. And that's a real stimulus, not only to real economic activity, but it also makes people in China more confident about the economy, and that makes them more willing to spend at home and also in places like here, in everything from business investment to buying real estate. And then the third big change I think we're going to see this year is in terms of regulatory policy. It's still going to be a little bit unclear and a little bit choppy, but last year it was really tough. We refer to it as a regulatory crackdown. Some of you might know that it made it hard for companies like Alibaba and Tencent, JD.com to do business. It was really tough on their share price if you're an investor in those companies. But this year, I think the government has learned some lessons. They're going to coordinate more with the private sector before they roll out new regulations. But the worst has already been done, and now they're going to be focusing on implementation. And one thing on this that I think is important is there's been, in my view, a lot of misunderstanding about what the government has been trying to do with China. Some people have talked about how they think the Chinese government wants to roll back the market-based reforms, the anti-entrepreneur, anti-private sector. And of course, that would be really bad for investment from China into the United States. But I think that's a mistaken impression. I think that what the Chinese government's been doing is trying to address many of the same socioeconomic issues that we're worried about here. Income inequality, wealth inequality, unequal access to healthcare, education, what they're calling common prosperity. It's the same kinds of things that we all worry about here. But they're just actually starting to do something about that. But I think it's going to be a better implementation, and particularly in real estate. I know a lot of you are interested in that. Last year, the government made it hard for people to buy a house to live in. this year it's already starting to get easier. And so I think by the second half of this year, the real estate market in China will be much healthier than it has been over the last 6 to 8 months. And I think that will also give people more confidence about investing in that sector here. So with that, I want to stop and turn it back over to Darlene.
Thank you, Andy. And so next, Lou, I want to ask you, why do the Chinese come to the US of A? I mean, there must be some complications, but why do they choose US of A?
That's a great question. Can you guys hear me?
Yeah.
So I do agree with Andy's comments and observation. I'm from China. I have families and friends in China, so I'm, I'm a little biased, but I do feel very bullish about Chinese economy, and I do visit China often before the pandemic. I think the China's economy is doing very well. I think there may be some bumps along the way, but in long term, I think the trend is upwards. The reason, while the China's economy is doing well, why will Chinese companies pick the U.S. for their foreign investment destination, right? So I think I can only speak based on my experience with my clients. So in my mind, I think there are 3 main reasons. I would say brand, demand, and regulations. So the first reason, brand. U.S. is still considered by many Chinese investors and consumers as a good brand. For example, product manufactured in the U.S. often are sold at a premium compared to similar product manufactured locally in China. And the second reason, demand. Right, the U.S. demand on Chinese manufactured product and Chinese services are still high. So many companies, like well-established companies, have started their U.S. presence many years ago. So you can see like Baidu and Alibaba and Tencent already have very established U.S. presence right now, and you can see many of them here in the Bay Area. But recently, because of the trade tension and tariff, things like that, and also the pandemic, travel restrictions, and Chinese companies used to sell directly to their U.S. customers, now choosing to localize, to set up their U.S. subsidiaries. So I think that will bring more Chinese business to the U.S. in addition to the existing big players. So the third reason, in my mind, I think is also the most concerning reason, is because I think Andy touched on that a little bit, the uncertainties in the Chinese regulations. Many of you may have heard that there were major changes and restrictions in the regulation.
China, who's not by any means, a big fan, because he said, this is the most remarkable development I have seen in the last 14 years. That China has reached and surpassed the tipping point, where from more of an import market in terms of technology, China is going to a very mature stage of also driving global trends now. So in a nutshell, if you don't come to China, China will come to you. And whether it's through your e-commerce portal, or through your electric vehicle, or through your robotics and health, your medical technology and imaging and radiology. It's not just made in China equals your phone, which of course is true, but it's everything else. So our view is that China is the epicenter of the global technology next wave of pretty much everything. Largely built off of what Andy said, the consumer. The Chinese consumer is the world's most aggressive consumer. It is the world's most digital consumer. It is the world's increasingly most ecological consumer. It is the world's most, it is still the world's, on average, younger consumer. That is changing also. But it has a tremendous appetite for technology and adoption. And that's going to change how we consume globally. It's going to change our, first of all, who we're marketing to. 30% of consumers in China are single-family households. So the aging consumers are growing at twice the rate of consumers in in the average. So it says that the whole demographic is going to be different. We're going to be building products for single-family older households who are digital. 50% of consumption is digital native consumption. And we're going to be building them so that people don't have to own them. They're going to subscribe to them. 40 to 90% of adults have some kind of online subscription. So ownership is increasingly going to be a thing of the past. We're going to be sharing, we're going to be essentially subscribing. So it's a more efficient model, which in turn creates a whole different price point. So people are going to have a tremendous number of experiences at a much lower level of income than they ever had before. And almost anything can be delivered. There are 45 million riders, 45 million orders delivered every day in Chinese cities through 9 million riders. So this is an amazing sort of evolution of an urban landscape that we've never really seen before. And it is an urban landscape, it's still cities. People have heard me say that before. But that's what Chinese people are buying, that is what they are investing in, and that increasingly is what you're going to be buying and investing into.
Okay, with that, let's hear it from Rajesh. Let's get an idea of how family offices fit in. I know that investing has changed, the models have changed, and how are family offices now making a difference? Let's hear from you.
Significantly. Thank you, Darlene. So just following up on Jonathan's comment, we're seeing increasing trend activity in the areas and that Jonathan pointed out in terms of AI, process automation, machine learning, data analytics, capturing large swaths of data to make more intelligent decisions in all aspects of business, whether it's healthcare, industry, or manufacturing. Taking a step back, at BNY Mellon, we have a very large family office group, and been out for 50 years, lots of relationships. We're seeing a remarkable shift in the way family offices are investing now versus they did 10, 20, 30 years back. And that's driven a lot by technology, but also the new generation that's coming on board with different ideas, different approaches to investing. And so we were recently heard the press, we can send it to you after this event. But the themes that came out were, one, change in philanthropy. The whole area of philanthropic giving and charity is completely upside down, where now the younger generation is much more involved in impact investing and driving for return in areas that they care about and they want to have a positive impact in areas of climate change and food scarcity and healthcare services and automation in those. And so these three areas emerged as the key impact investing themes for family offices. That was one philanthropy area that was changing big time. The second key theme that came out from family offices was this whole area of digital assets and crypto. Over 77% of the families said this is the fastest growing sector in their investment portfolios. They're either exploring and investing in right now or investing actively in. And whoever's investing actively is actually growing their allocation to all these applications of digital assets, not just the coins and currencies, but also in applications involving tokenization and building fintech, etc. So digital assets and crypto is another key theme. The third was a huge focus on cybersecurity. Everybody is just thinking this is as important a time as any in terms of focusing and investing in cybersecurity. This is the #1 need of the hour right now. And so a lot of family offices obsessed with having the right tools in place to safeguard their assets and resources and investing in cybersecurity. And then finally, lending. Family offices are just massive users of credit. And so whether it's domestic or global, the need for credit is much higher than ever before. Whereas they perhaps see rates going higher in the future, and so they want to lock in credit and lending at attractive rates and have that capital and be opportunistically invested in areas that they care about.
Thanks, Rajesh. I have a question for you all. Any one of you can take this. Bloomberg News recently noted that both China and US are still investing large amounts of capital in each other's country and economies, right? Just not as freewheeling as before. So what do you think are the drivers of this phenomenon?
I think that private individuals in both the US and China have a very different outlook on the other countries. There's a lot of tension between the governments, but witness those of you in the room here, I think most Americans and most Chinese people, whether they're students or tourists or business people, have a pretty strong appreciation of the other's culture and society, but also the opportunities in both countries. And so I think that continues. And actually one of the good things that's happened lately in our country is that the Biden administration just a couple of weeks ago decided to end what the US Justice Department called the China Initiative. And some of you, I think, are familiar with this. This turned out to be, in my view, kind of racial profiling, which I think had a very negative impact on our science, technology, pharma, biotech, AI industries, particularly those associated with Chinese scientists. And so I think ending that is going to give more confidence to US companies and also to Chinese investors and scientists that the room for collaboration and cooperation is back open again. So that's very, very positive.
Yeah, we actually have members from the Chinese consulate here, actually from the Ministry of Science and Technology, so I'm glad they're very happy to hear that. So thank you for sharing. What about from the tax perspective? I just want to hear, Lu, what is your comment?
Thank you, Dali. So I do want to make a quick comment about Andy's comments. And so, I think despite the becoming more interconnected, right, they cannot really live without each other. And so I said, the reason that the Chinese companies and individuals keep investing in the U.S., I said 3 reasons, right? U.S. brand, U.S. demand, and then also Chinese regulations, right? I think that on the other way, why the U.S. companies and individuals keep investing in China, I think there are maybe 2 reasons. I think I'm just like, 2 reasons came to my mind. One is some of the regulations, especially in the healthcare sector, like the CRO, the clinical trial regulations, and the stem cell related regulations, maybe not as restricted in China nowadays. I think that provided opportunities for U.S. individuals to explore more, to push it further in China. I think the second one is talents, right? So the number of young, talented professionals and engineers and technicians in China are really be the main drive of the successes of the U.S. investors investing in China. So as a tax advisor, right? So coming to your question, now it's commercial time. As a tax advisor, my job is to help cross-border investors and companies to reduce their tax burden, right? So we are involved in many decision-making processes with our clients. For example, if a Chinese company decided to, set their boots on the ground in the U.S. for the first time, should they hire an independent contractor or should they hire an employee, right, as a first step? And then, when they thinking about like having or set up a warehouse in the U.S. or having a computer server, can they do that? What are the tax implications? When they are ready to set up a legal entity, what are the differences between a U.S. LLC and a U.S. C corporation? And then there's many other considerations as well, like how do you fund your U.S. operations? What are the differences between a loan versus a capital contribution? Things like that. I think we just want to be, stand by on the side and be with our clients every single step along the way.
Thanks, Lu. And so, Rajesh, I'm going to give you an opportunity for your commercial time. So, how does BNY Mellon actually help their clients, right, invest? How do you find these opportunities?
Well, thank you, Darlene. I'll try to be very objective. But, you know, family office space is unique in the sense that there's no two families alike. You've seen one family office, you've seen one family office. And, you know, Woodland Capital and Judy can vouch for this. The beauty and the intellectual sort of satisfaction in working in this space is you work with some of the most sophisticated investors who have grown their capital significantly, and are now at a stage where they want to explore what the opportunities are globally without any constraints in many areas. And so we're seeing a lot more activity in the areas of private investing, whether it's direct venture or professional managers in specific areas. So that, to us, in the most recent survey, almost 90% of family offices said that's the growth area in their portfolios. So that's certainly one area where there's a lot more activity at the cost of perhaps, you know, something like fixed income, which is a little more challenging. You know, bonds are not as attractive today as they were 20 years back, right? For obvious reasons, the rates and the Fed policy being what it is. So a lot of the capital is being drawn into the more equity-like areas such as direct investing and private equity and venture as a result of that. The second big trend, I mentioned this before, Darlene, was the whole area of philanthropy is changing. And you mentioned, you know, why is there more cross-border activity between the US and China? It's the youth, it's the generational shift that's driving a lot of this change. Even within family offices, there's a greater awareness and need and direct activity in investing in impact and social impact in portfolios, whether it's gender equality, whether it's environment, or whether it's governance. And they want to measure the results of the investment, and they want someone who will point them towards very specific, tangible impact investing, and be able to use their significant capital to affect change, things that they value most of all. So that's another big area of emphasis for family offices. And finally, families, like I said, are exploring more emerging asset classes, the areas of digital assets and crypto, where BNY Mellon is so as the world's largest custodian, taking a leadership role in developing how to custody digital assets and come up with an ETF, etc. So we're looking at where the families are heading in terms of their global investing approaches, whether it's direct investing, private venture, digital, etc., and then offering them opportunities to invest in those specific areas.
Great, thank you. Jonathan, you want to add, or ask you a question? I'll ask you a question. Since diversification, both horizontal and vertical, is now the name of the game, can you describe the changes in capital flows? Capital flows.
Oh, well, I guess I can build on what was said. First of all, I'm surprised that real estate hasn't come up yet, because I think it's the single biggest flow.
Right.
I mean that 75% of our wealth on the planet we hold literally in the ground, in buildings and land. And most of the liquidity that we've had over the course of the pandemic has gone into asset price appreciation, mostly of real estate. So as I would expect that the majority of foreign investment from China is in real estate, and it is very concentrated around major metros. So that, I think, is the first flow. And when you say vertical integration, very much there's just a lot of this is about families becoming global. And so one of the things you do is to vertically integrate. You want your place, and then that helps support your family's education and your peripheral investments around factories or whatever other work things that you think you're doing, and investments, of course, in technology. I think a lot of this is very much driven by families and households. Households own 90% of the world's wealth. So at the end of the day, this is all about essentially a relatively small number of people making relatively big decisions for themselves. And as we think about ourselves as a community, as a receiver of all these investments, the question is how does one want to shape that? Because be careful what you wish for, you might just get it. And that I think is when we talk about vertical integration at a community level, it's about the integration of wealth and its effects on society. its effects on affordability, its effects on sustainability, its effects on innovation, talent. These are the things that we should be caring about as we integrate into the global economy. And finally, from a company perspective, we think globalization is not dead, it's just changing. It's more digital, it's more services, it's more Asian. So these are the things that will characterize globalization going forward, and we will see vertical integration. So Asia today is almost as integrated as Europe, and it did not take 2 world wars to do that. It actually created integration through trade, through technology. So there are 10 super apps which have individually 20 million plus monthly average users across Asia. So the super apps are another form of vertical integration where you're bringing together all of these different players in one WeChat universe, one big happy family. So that, I think, is that's the new meaning of integration. It's the ability to have an open architecture, to exchange information, to exchange capital, to exchange talent. That's what integration, and that's what vertical integration means today.
From the audience? Yes, please.
More of a general question. It perplexes me to see, well, the question why the Biden administration continues to perceive China as a threat and refusing to acknowledge the potential cross-border activity. Any opinion on that?
I'll repeat the question. It seems like the Biden administration continues to see the U.S.-China relationship, or China as a threat. Yeah, why, right? Yeah.
I just understand.
Okay, they're all looking at me.
Yes, Andy.
I think that the best way to respond to this is for all of us to take some responsibility for this, in that it's not just the Biden administration that has that view. You could argue that one of the very few issues that both Republicans and Democrats in Washington agree on is that China is a threat to the United States. And I think part of the problem is there's not enough knowledge, there's not enough experience. Very few people in our country have been to China. Very few people know any Chinese people, maybe other than government officials. And so there's not enough of an interpersonal connection and an understanding of what's going on. So I think when I talk to groups like this and that question comes up, my response is always, if you're politically active and you're concerned about this issue, make it part of your advocacy with your elected officials, whether they're at the city level or the state level or in Washington. So let them know that our societies, our economies, our lives are really interconnected and really interdependent, and that especially right now, given what's going on in Europe, the idea of not stopping and saying, especially at this point in time, don't we need to figure out a way to put the political relationship between China and the United States back on a better path? And I think, you can write a letter to President Biden, but I think you'll have a lot more impact by talking to officials who know you, either because of your community activism or because of your financial support for their campaigns. So that's how I understand the question.
Thank you. And with that, I'm not going to take any more questions. I don't want to be between you and your next glass of wine or your next appetizer. So I want to say thank you to all our panelists today. Thank you so much for your insight and for your information. And with that, I do want to again thank our sponsors, Woodland Capital, the City of Guangzhou, and also BNY Mellon. And also to, most importantly, for providing the food and also our drink, to George Chen and China Live and Tony Poon and their staff. Thank you all. And with that, please continue, have a good time, and we'll see you at the next event. Okay? Thank you all.